Good afternoon. Thank you all for coming. I was a little concerned about the turnout, but I was lucky enough to be on the pre-conference agenda, so I'm guaranteed to be at least in the top two for my time slot. So thank you all for coming. Today's topic, succession, business continuity planning for franchisees. I have no clickers up here, so I have some audio video, so I got to say next slide. So next, please. So before I get into the meat of it, I'll jump back to June of 1979. At the time, my father was a McDonald's executive, and he had made a decision to become a McDonald's franchisee, and that opportunity ended up falling through. So he ventured outside the brand and happened upon the Burger King brand. And as I was told, I was young at the time, he was offered either the North Carolina market or the Little Rock or the Arkansas market. So he chose Arkansas for whatever reason. So in the summer of 1979, my brother, my sister, my parents, my two grandparents, and my dad's parents, and our two dogs packed up from Slidell, Louisiana, and moved to Jacksonville, Arkansas. From there, we moved into a two-bedroom apartment while we were waiting for our Burger King to be built, and Flis Enterprises was born. Next slide. So this is our first. Next. This is our first location in its current incarnation. We started with one store, and like I said, we lived across the street. And I kind of joke with folks who are in the business now that I started in fast food when I was 5 years old, and it's actually true because I can back that up because I was in the back in the kitchen, standing on a chair, putting raw Whopper meat through the broiler with my bare hands. So I was in the business, so my brother and sister and I went through our primary education, and one store became three, and so on. This store has been modified at least once, because I remember my dad used to send me out to pick up trash in the parking lot, and I would go by the drive-through window to look for spare change. No credit cards in those days. So I can assure you there was no awning over the drive-through because I got rained on many times. Next slide. So my parents, my brother and I and my sister were going through our primary education. My brother and I ended up going to the Naval Academy and into the Navy. He was in the Navy until right around 2000. He left and came into the family business, and I stayed in. That's a picture of me. Was a picture of me. Present day, minus a couple years. And at the time, my mom's health was not the best, and she passed away in 2007. And we're actually here in November of 2008. And my dad, that's me flying over the Kitty Hawk. You can see her just back there. And we were here in 2008, my brother and my dad and I, and my dad was subsequently diagnosed with pancreatic cancer and passed away in February of 2009. So our succession plan, which we thought was going to be some years in the future, was then snapped into place. So with that backdrop, we'll go into the meat of the discussion. Next slide. So talking today about continuity for planning for franchisees. Next slide, please. We'll talk about three main types. One, succession planning, business continuity planning, and then some financial continuity planning next. So with succession planning, we'll spend the least amount of time here. This is the most intentional. So generally, next slide, please. Next. When you're selling to an outside buyer, generally it's planned out on your own timeline and a part of a bigger financial plan. Next slide. So with that, some things just to be aware of, things are commonly overlooked. One is the amount of time that the sale is going to take. You're not renewing your driver's license here. This is a pretty extensive process, and you might have a sophisticated buyer that introduces some complexity into the situation. So when you add time and complexity together, it's going to introduce some stress into your organization. And then after, when all that is done, at the end of it, hopefully you've had a good exit. Now you have this check in hand, perhaps. So what's the 2.0 plan going to be? And from experience, I can tell you that sometimes having a time problem, meaning what am I going to do with the time going forward, can be just as bad as having a money problem. Next. Okay, business transfer. Here we're talking about succession within your own family or perhaps within your own organization. So some things to think about there. Next. For the first is fragmented ownership. So just for our family, when we started, my grandfather put up the funds, and my mom and dad were the operators. When my grandfather passed away, my father and my siblings, we inherited different shares of our a business. And then if you look beyond us, there's six grandchildren, if you will. So you can see just in our small little family business, the ownership can get quite fragmented, especially when you start introducing spouses into the organization. Okay, next. Second, so then leadership transfer. For our business, my brother had been operating in it for about 10 years, so the organizational leadership was rather seamless. But if you're going to have somebody come in who has been working in your organization for quite some time, that may introduce some organizational challenges. And then if you have multiple folks coming in, then you have multiple folks in new roles, which collectively can have some challenges for you as well. And then if you're transferring while you're still alive and you're going to be around after in the same organization, how is the founder going to participate? Is he going to go to the stores or not? And how's that process going to be handled? Okay, next. Okay, and so estate. So for every client of my financial planning firm, we have a heavy emphasis on estate planning. So every client who comes in, if you don't have an estate plan, that becomes item number one until it's completely sorted. And sorted being defined as the documents are drafted, they're signed, they're notarized, they're scanned, they're uploaded, and you have fingertip access to them on your devices. And that remains number one until it's done. For those folks who come in with the business, it's the same thing. You have to have an estate plan for your business in case something happens so that your business can go on and succeed you after you're done. So with that, liquidity. So if you're going to be transferring and there's going to be an estate tax involved of some sort, you never want to be caught out by not having the funds available to pay whatever the transfer tax is. And how's that liquidity going to be provided? If it's an insurance policy or other sources of liquidity, you want to make sure, obviously, that those are going to be available when the time comes. And then insurance. So if you have your internal buy-sell agreements that are funded by life insurance policies, you want to make sure those are up to date, that the premiums are paid, and that all of the beneficiaries are correctly annotated. And then lastly, as the transition happens and the new owners are in place, you definitely want to have an estate plan for everyone who's involved with the business. Some real interesting things can happen for people who die without a will. In my home state of Tennessee, for example, if you die intestate without a will, so say, for example, I had 3 children and I passed away, my wife would inherit half of my estate, and my 3 children would inherit the other half in equal shares. And my wife couldn't be the guardian for the children because there'd be a conflict of interest there. And that all would be overseen by the court. So the way to circumvent all those problems is to have a very cogent, solid estate plan, which is part of the reason that we put such a big emphasis on it in my firm. All right, next. Okay, so that covers the business succession. Now we'll move along to continuity planning. So we'll talk about two main types. One is the macro level, and the second being more on the operational level. So macro, think COVID, things that affect the entire country, and or if you have a brand specific thing. So say, for example, there's a media event that happens somewhere in another part of the country, but it affects your brand because of the national attention given to it. And on the micro level, think something more local, like a key man issue or a localized natural disaster. Okay, next. Okay, so on the macro level, thinking back to COVID, what are the main things that you want to be able to do if you have a contingency? Well, number one for us was communication. Since we founded the financial planning firm, we had been operating virtually for the entire time. My family business did not have the means to communicate in a distributed way with across the state to all of our folks. So we leveraged our communication system to do that. Second is logistics. So fortunately for us, my brother is on the supply board for our brand, so we're able to have insider knowledge of how we're going to supply all the stores. But you want to make sure that if you're going to be open for business, that you have all the stuff you need to be able to execute. And then, are you going to be open for business, either partially, drive-through only, or dining room only, or some other way? You want to make sure you get the answer to that question. And then access to capital. So for all the things that we do in finance, EBITDA, EBITDAR, return on invested capital, return on capital, return out, wherever you have, what have you. During COVID, there were 2 main things that were prime. One was how much cash did you have, and the second one was what was your burn rate. So you divide the first number by the second number, and that was the amount of time you had until you were going to have some real cash flow problems. So access to capital, which I'll talk about later, is a pretty important thing to keep in mind in a contingency. Okay, next. Okay, for company specific stuff, so key man stuff, we were actually in an endeavor where our director of operations, not part of our Burger King organization, it was a separate deal. He actually passed away unexpectedly, and which of course was sad. But beyond that, we had no access to his devices or to his computer. So all that corporate knowledge he had within those things was not available to us, which presented some operational challenges. So one thing to consider non-financially is how are you going to have access to all those things if someone is unexpectedly not within the organization anymore. And then second is insurance coverages. So on my brother, primary operator, we have a key man disability insurance policy. So if my brother becomes disabled, separate from his own finances, the business has a source of funds where we can pay relocation expenses, headhunting fees, what have you, so we can replace those services that he provides to the company. Similarly, we have a key man life insurance policy so that if something happens, we can serve the same sort of functions. And then, so you want to make sure that those things are, like I said, up to date and that the beneficiaries are well detailed in accordance with your contingency plan. And then lastly, are you going to be open for business? You have a localized natural disaster, maybe drive-through only, maybe dining room only, maybe closed for a little bit. But again, you want to weave that into your capital structure to make sure that your business is able to sustain itself through the contingency. Okay, next. Okay, so in a nutshell, do you need to have a multi-volume plan that you're going to pull out when you have a contingency? No, but I think it's very important to have the basic things that you're going to have that are going to be common to all contingencies, so that when they happen, you're not planning during the contingency, you're executing, so that you can see yourself through whatever that is and get to the other side. And then test that every now and then for its currency and its relevance. For my financial planning firm, between Thanksgiving and Christmas, we test our continuity plan every year, and we update it as it's required. I would encourage you to do the same thing. Maybe perhaps not yearly, but at least with some kind of frequency. And then don't dismiss the unexpected. And here, one greatly overlooked thing for organizations is disability. Believe it or not, your chances of becoming disabled exceed your chances of dying well into your 60s. So you probably want to pay a lot more attention to disability than you do to life insurance, because when it happens, obviously it's not planned, and it's normally going to happen at a time, of course, that's not predictable. So certainly don't dismiss it. And then lastly, lay off risk where it's economical to do so. For personal financial planning clients, every single client has an excess liability or umbrella insurance policy. Every client of my firm does. Business clients, we encourage them to have business umbrella insurance policies as well, because you can spend a lot of time building this great financial tower, if you will. But if you imagine like playing Jenga, that little thing on the bottom, you have that one thing happen that just pulls the bottom out and the whole thing collapses on itself. Umbrella insurance and other types of insurance are ways to keep yourself fortified through the contingencies. Okay, next. Okay, so for financial continuity planning, we'll talk about 4 areas, the first of which is resilient corporate finance. So next slide. So I'll take you back again to June of 1979. So for us, the financial structure was very simple. My grandfather put up the money. My parents were the operators. They went hat in hand to the local bank and tried to get a loan for their FF&E. At the time, believe it or not, the franchisor bought the land, built the building, and all we had to do was occupy, pay rent, pay royalties, and then pay our loan to the bank. Largely speaking, for the first 15 years of my family's business existence, that was kind of described what our financing was like. So when I came into the business after my parents passed away, the first thing was the bank. They were of course sorry for my loss, but they said, yeah, before you go back overseas, we need you to sign this piece of paper that personally guarantees all the debt for the company. Like, what? I'm just the Whopper guy who puts through the boiler. They said, no, not anymore. So I had to take a look because of some of the financial training I had at what our capitalization was at the time. And it's not that it was bad. It's just that it was mechanized mainly for success. It wasn't mechanized very well for if things didn't work out entirely like we planned. So when I came into the business, I put a big emphasis on cash flow. I'm a cash flow investor, so I want to have positive cash flow from the investment as early as I can. Some may differ with that view, but that's mine. The second one is less of a reliance on debt for expansion. So we put a lot more equity into things that we were doing. And then lastly, a big emphasis on liquidity. So with that backdrop, I'll describe what our capital structure is today. If you see on the screen on the left, you probably recognize an operating company and a real estate company. On the operating side, on the bottom there, we have basically our compensating balance account with our primary lender, and that's our daily checking account. Completely separate from that, we have at a different institution, we have a trove of funds that's for the care and feeding of our current store set. From that, we can do repairs and maintenance that we can't fund through our normal daily operations. Beyond that, and then also too, if our brand introduces a product for which we have to purchase equipment, say $5,000 or $10,000 per store times 23, thank you very much. That's where those funds can come from. Separate from that, we also have another trove of funds that's for future growth in the rainiest of rainy days, if that were to happen. So we have that. Remember, I talked about that access to capital. So in a contingency, your lender might restrict your funds flow in their accounts at their institution, and their goals might be different than yours. So by having multiple layers of capital to which you can access is going to increase your flexibility during a contingency. And then on top, right now we have no operational debt outside. We certainly have in the past, and we might have in the future. But today, having none of it has been the right move for us. We still do what I call inside financing, which I'll discuss in a minute. Okay, so that's the operating company, and then on the real estate side, starting at the bottom, we have one outside lender, and which gives us one payment we have to make every month, and that's it. That loan was refinanced in 2021, generationally. Very, very generous terms that we may or may not see ever again. But at the time, it was a great deal for us. I don't put my foot down on much, but during and right after COVID, I said, hey, we are going to have 12 months of loan payments sitting in reserve on our real estate company, so that if anything were to happen, we could sit in our hands, let the thing unfold, and know that we could make our loan payment to our lender for 12 calendar months. On top of that, at a separate institution, we have other funds that serve two purposes. One is for our allowance for refinancing, but also future growth. So for the refinancing, as I mentioned before, in 2021, the terms were very, very generous. When our term is up in 2028, I think it is, that probably most likely won't be the case. So to make sure that our monthly payment doesn't run away from us on our refinancing, we may have to cash into that refinancing a bit so that our cash flow sort of stays constant. So that's what those funds are for. And then also we have other funds on top of that. We can fund future growth. Now, because we don't need the funds necessarily until later on into 2028, we have free use of the funds now. So what we do is we buy treasuries. 2 years ago, treasuries earning squat. Now, something more significant. So that's been good for us. But on top of that, we can do portfolio loans we can borrow against those, and we can loan the money to our operating company. So the reason we do that is, number one, the rates right now are currently better, but it's very fast. There's no underwriting, and then my favorite, there's no personal guarantee on the debt either. And then if something happens on our operating company, we can negotiate with ourselves, which is, of course, much more pleasant than negotiating with the bank. So why lend money to ourselves? Well, in my world, every entity every tub has its own bottom, including our operating company. So when we make these loans intercompany like this, they're arm's length loans with a maker, with a borrower, an interest rate, and a schedule to pay the funds back. That may not be the case going forward, but that's worked out well for us recently. Now, folks may look at this capitalization structure and say, wow, that is way, way conservative. You could do so much more if you just did this. And that's certainly true. But at the end of the day, the principles of the business have to be able to live with what the capitalization is. And for me, I sleep very well at night with this capitalization structure. Other folks may say, yeah, that's pretty conservative. But at the end of the day, my parents gave us this thing that they started in 1979, and I don't want to be the steward of its premature demise. I fully respect folks who have built it up and lost it all, and then had the great comeback. But that is not the presentation I want to give at RFDC. So this capitalization structure makes a lot of sense for us right now. Okay, next. Okay, so moving on to real estate. For some folks it makes sense, some folks it doesn't. One, does your brand allow for it? And some in our brand, we're allowed to own real estate. Not every brand is the same. But you have to answer, like, where's the funding going to come from if you can't do it internally? If you cannot, obviously, if you can't fund all the money for the real estate, you have to have a lender to satisfy the rest. And one big blind spot that my parents had was they were going to buy into real estate that they were going to hold in perpetuity, regardless of how the performance of the store was. When I came into things there, we had to have a plan to get out of the bad locations because they are a serious drag on your resources. Our best performing stores, we probably don't spend 5 or 10 minutes collectively discussing those things year to year. Our underperforming stores, it's 100 times that, and it's 100 times more stressful. So bad locations, you want to have a plan together, which I'll talk about more in just a minute. And then for the popular tools, I'm talking here about sale leaseback, 1031, refinancings. Definitely use them, but I would use them judiciously and make sure that if you are using them, you're using them in a way that's serving you. So don't just do a sale leaseback for the sake of doing it. Make sure that the purposes that you're doing it for are what's optimal for your organization, not just because you want to do a sale leaseback or a 1031. Okay, next. Okay, so I'll give it just a quick case study. So in 2014, my time in the Navy was coming to an end, and I was in Little Rock, and my brother and I were talking about the business. And he came to me and he said, after operating, we talked about real estate. He had a yellow legal pad. He likes to use those, and he said, the real estate company is not making very much money, and I don't know why. So if you've never been in a family business, two alpha males, no one's ever going to ask for help. So him saying that was his way of saying, hey, I think I need some help here. So I have to be careful what I say. He's not here to defend himself, and some of the folks here, I think they know him, so this might get back to him. But we so I took a deep dive into real estate and what was going on with our organization. So the very first thing that I did was we divided our real estate into 3 primary buckets. The first bucket was, we got to get out of here bucket. The second bucket is, we're happy to have it, but we don't need to keep it if the situation warrants it, selling it's better for us. And then the last bucket is stuff that we want to keep in for the long term. So the first order of business was try to get ourselves out of the places that we didn't want to be. So for that, being located in Arkansas was actually a benefit because we had a couple of our sales, folks who were selling in the 1031 market had funds left over, and they came into the Arkansas market because they could afford to complete the rest of their 1031 exchange with our properties. So our most troublesome property, we were in and out of escrow probably, I think it was 8 or 10 times, but we finally got the thing sold, and we had an exit plan for that property ultimately. At the end of the day, over the course of about 5 years, we did six sale leasebacks. We purchased 2 sites from our landlords. We added 2 new locations, and we rebuilt two existing sites that needed to be scraped. And then the crowning achievement of the whole thing was our refinancing in 2021. So now the way that we're organized, we're going to hear probably in a couple hours, and probably at some point during the conference, are we going to have a recession? Is it going to be a soft landing, a hard landing, or no landing, or whatever it is? For however well-intended any of those presentations might be, at the end of the day, they're just a educated or informed guess on what's going to happen in the future. I don't know what's going to happen in the future. What I do know is that sometime between now and later, we're going to have a recession. We're going to have prosperity. So I am completely out of the business of trying to predict floods. I'm trying to build financial arcs so that we can persevere through all of those situations. And right now, we are. Because we don't want to get caught out of position. That's the worst place, in my opinion, to be with your finances. So if interest rates go down, no problem. We can all adjust to that. We have properties that are available, for sale that we don't necessarily want to keep. If the current environment remains the way that it is, we're adequately mechanized for it. If interest rates go up, then because of our reserve funds, we hopefully can persevere through that as well. So for me personally, what I model for our refinancing is 10%, 15-year amortization. That's what I'm planning for in 2028. Could it be less than that? Great. If it's more than that, we can hopefully persevere through that. It won't be too painful, but that's what I look at in our finances going forward. And going through this process, it was actually kind of fun because we got to move the jigsaw puzzles kind of around the board and optimize our own resources. For example, next, I was on the phone with our primary sale leaseback professional, and adjacent to one of our markets, one of our sites, we were looking for additional places to build Burger Kings, and we happened upon this thing. It was an intersection of Main Street and I think Broadway or something within our market. So we found this site, and there was a strip center. I think it had a karate dojo in it, and then this building up here on the left. We didn't get the car with the building, but it was a post office, I think, at one point, and then it was some kind of industrial thing. So we found out who the owners were. Grandma finally got paid on lot number 2, I think, and we bought both of those. And through multiple soil studies and whatever, we ultimately ended up with our Burger King in May of 2018. And then next, for this site, we had our largest one month sales for any site. And I finally got to experience what it was like to be a moderately below average Chick-fil-A franchisee. The site doesn't do this sales anymore, unfortunately, but it still is a good earner for us. All right, next. Okay, expansion, development agreements for us, they haven't made a lot of sense. So I never want to be a distressed seller. So for us, when I look at operating at development agreements, they can sometimes force you into being a distressed buyer. So for us, those have not worked out well. That's not to suggest to somebody else that they might make sense. For us, they haven't worked out, at least in the ones that I've seen. Acquisitions, we've not done broad acquisitions outside of our market. It's just that hasn't been our game. We have done, a lot of Burger King franchisees have tagged in parts of their group in our state that they've wanted to exit. So we've been able to pick up onesie twosies here and there. I think we've done it 3 or 4 times, and it's been, generally speaking, pretty good for us. But whenever you're doing expansion, I strongly recommend modeling adverse scenarios. For our market, if I have a spreadsheet where the sales are $2 million and they're going to increase by 5 or 10% every year for the next 20 years, well, that's the easiest spreadsheet in the history of spreadsheets. But when I plan for $2 million and I get 1.3 million, that's where things get a little bit different. So you want to model that so that one store selection doesn't yank the rug out from underneath your whole organization. Because opening up stores is expensive. I think right now, if I had to tally it up, we're at about $3 million just to open a new site, and that's before you sold one single Whopper. So there's a lot that kind of goes that goes into it. And I have no preconceived notions that Burger Kings in Arkansas are the best investment that one person can make. So I'm always constantly circling for what's optimal for us. Okay, next. Okay, probably the most boring, but probably one of the more important parts of the presentation is retirement plans. So I'll go back to my parents. So when my parents passed away, they were Burger King relatively wealthy, but non-Burger King stuff, it was much, much more modest. That's not bad, but what they were relying on was a very good exit and or having the real estate provide an annuity for them for their entire retirement. That's a great plan, but it's not guaranteed to work out. So when I came into the business, we talk about something like EBITDA. EBITDA is great for somebody else because that says what's your debt paying capacity to pay to someone else. It says nothing about what you can pay yourself. So it also ignores depreciation. So we can say with absolute certainty that our restaurants and the equipment that are in them are dying a little bit each day, and eventually they have to be either refurbished or replaced. So when I came into the business, I had this term that I call distributable cash flow, meaning that cash flow, but we're going to have an allowance for replacing our equipment. We approximate it with our depreciation expense, and we don't necessarily distribute the cash flow on top of that, but we want to be able to distribute it because that's the intent of the business. So one way we mechanize that is we take money out so that we can fund these things here. So IRAs are a great place to go for multiple reasons, not the least of which are the tax benefits you get from an IRA, but also too, in most states, not all, IRAs enjoy very generous creditor protection, even outside of our personal guarantees. So if something were to go really, really sideways with the Burger King franchise, yes, that's a bad day. We hope we don't get there, but we have this other thing over here that's going to see us through if the fast food business doesn't work out for us. So that's IRAs. Second is a 401k. If your business doesn't have a 401k, I strongly encourage you to get one because they become very, very inexpensive to operate, both on an annual basis and also on an ongoing basis. The costs have come way down. But not only that, the amount of money you can defer into a 401k greatly exceeds what you can put into an IRA. And on top of all of that, a 401k is an ERISA plan. And that enjoys the highest degree of creditor protection available in the United States. So if things go really bad, at least we got what's in the 401k to see us through. Now there's other asset protection stuff that you can do, but those are pretty simple ones. Cash balance plan, may or may not have heard of this one. This is a defined benefit plan nominally. And it doesn't make sense for every organization, so please don't take it that it's best for your organization. But it could make sense for some, primarily if the owner is significantly older than all the other employees in the organization, because the way that they calculate the contributions, again, it's a defined benefit plan. It gets a little bit complex. That could have a tremendous benefit, especially if you're about to exit. And then the deferred compensation, that is not a lot of benefit to owners per se, but if you have a key employee that you're looking to up their benefits for, deferred compensation can make a lot of sense for those. So again, not the sexiest part of franchise financing, but again, these things could really see you through if things don't work out well. Okay, wrapping up, I think next. So for us, we inherited the business in 2009 from my parents. We were successful enough to be included in the Franchise Times at some point, badge of honor for the organization. It's not been 100% smooth, and we certainly have made some mistakes along the way. But for my family, my great grandmother came over on a boat from Poland, and my grandparents were the first generation here in America. And what started off as $100,000 from my grandfather back in the day now is a robust, sustainable franchise. And I think my parents would be happy what they left us with and what it's kind of grown into. So, all right, that's it for the formal presentation. If anybody has any questions, I'd be happy to take those. Trust. Okay. So the question is about trusts. I'm assuming as it relates to estate planning. So obviously I am not an attorney. As part of a complete cogent estate plan, a trust is typically recommended for folks. So when we work through an estate plan, typically it's arm in arm with an estate planning attorney, and a trust usually is one of those things. Is for my family's business? Oh yeah. So we have different. So for my family, it's kind of interesting. We have different ownership percentages for the operating company and for the real estate company. But we have a separate entity for our real estate that owns all the different properties, and then and that's how it's mechanized. It's very similar to the operating company as an ownership structure, but it's just a little bit different on the percentages. If that so generally, I think the question is how do you organize your real estate? So for us, we have an operating company that's its own entity, and completely separate, we have a real estate company that owns the real estate, and so they're completely separate for practical purposes and I guess for legal purposes as well. I think that structure is what's recommended for most folks. So does that answer the question? Okay, yes sir. So I think the question is to differentiate between, like for example, a Burger King franchise and just a regular business. Yeah. So yeah, that's a good question, because for us, like when you come in, when you inherit portions of a franchise business, your franchisor has to approve all the franchisees before they can become approved franchisees. So that's one concern. But then the other part is, and then it comes into succession. So how's that going to happen if something happens to the primary person? Because the franchisor wants the person that they're going to go to if something happens. So in our case, more likely than not, if something were to happen to my brother, the primary operator, we probably will replace him with a professional who's outside of our family, so that we'd have to make sure that they get. But now, for example, with my financial planning firm, we don't have a franchisor per se, so that business can persist in a different way, going forward. Does that answer the question? Okay. Yes, sir. Okay. So the question is, what do you do for bad locations? Well, for first off, you want to have a better entrance strategy, but no, not to be trite. You don't know if it's going to work out. So actually, when I was here, we didn't do any sale leasebacks, and I actually, no kidding, I was driving my car and I got a cold call from a sale leaseback firm, and I had mentioned, yeah, we've got this, we've got that. And I said, yeah, then we've got this other property that we're going to have to take a loss on. He's like, take a loss? What are you talking about? Well, he explained to me during that a phone call the concept of occupancy cost. So, which is probably meant a lot to me. Maybe folks here, it's a little bit more well understood at the time. But for us, we were able to set our rent at a price that we could afford for that location. And at the time, because the cap rates were such that we could get a multiple on that rent that was digestible as far as the loss goes. So we didn't get made completely whole, but we were able to organize our rent so that we could extract the capital that we had left that we could from the site, but still stay there as an occupant throughout the franchise. I don't know the exact number for our worst location. I don't know the exact numbers of what our loss was, but there was definitely, we put more capital in than we got out, but we were able to extract some capital from it. But now when the franchise agreement expires, we can just hand the keys over and walk away, as opposed to having to stay in the same location. Yeah, so yes. So the labels I put on the different funds that we have, they're all available for whatever we need them for. They're just kind of earmarked in my own brain about for what we need to do. But if the right situation were to come along, certainly all the capital could be used for different purposes. But for me, expansion's tough. It's a very, very big capital expenditure with an uncertain outcome. So you got to be really sure before you jump into that one. One of the harder. So I think the question is what kind of returns are you looking for on a scrape and rebuild? So for us, one of the challenges with restaurateurs is, and I don't want to characterize my brother this way, I'll characterize restaurateurs in general, is they have a great reluctance to shrink in size. So if they're out of sight, they either want to get more or at least keep what they got. So I try to, as an outside person, I try to introduce controls into that with the same kind of mentality that you're talking. Hey, what are we looking at for returns here? So I look at it on a cash flow basis. So if we are able to sell something over here and we're able to 1031 the money into our scrape and rebuild, then we'll look at that as, hey, do we have the funds to do it? Then we say, how does this volume for this location relate to our average volume across the set? If it's either going to help us or it's going to hurt us, that's another data point. And then what's the cash flow we're going to get on the real estate once that's done? To answer your question, I don't know that I have a specific rate of return in mind. I want to say it'd be something that's above what your treasuries are at a minimum, because that's the risk-free rate. But to be honest, since interest rates have gone from 0 to 5, we haven't had to confront that issue yet. But I think where I would start would be if I invest money into this site, either via a scrape and rebuild or a refinancing where I have to do a massive remodel for the store. How much money can I take? Can I take that money back out of the business over the life of the franchise agreement? Is where I would start. So the question is, what do I recommend for succession planning when you don't have a family member to succeed you? Yeah, that's an interesting one. So if I had to, on the spot here, probably what I would think of is I would probably recommend having something like a trust, that if the sole owner were to pass away or become incapacitated, they would have a successor trustee who then could oversee the sale of the business for that person. When you have a trust, think of your trust is like you're a financial being that succeeds you after you pass away. So then the trustee would then come in and go through the whole process of selling that we described before. That's just one. That's just off the cuff. There may be some other things. If you have a larger family, you have distant nieces, nephews, whatever you want to have as benefactors or a charity, could be another thing there. So, but if you're in that situation where you're the founder and you have no successors planned, I would have a very, very cogent estate plan, because your organization is going to be penalized severely if you have an unexpected accident. The questions about ESOPs. The way ESOPs were explained to me, I've never participated in one, is it's basically forcing your employees to buy your business from you, is the way it was explained to me. So I don't have enough knowledge about ESOPs to intelligently comment on them. So I'll have to punt that one. So I think the question is, how do you rationalize the economics of a real estate company with an operating company? The short answer is, with a family business, you gotta swallow a couple of painful pills every now and then, especially when you have different shares ownership of each entity. For us, I look at it as, I want my family to win. Because we have different ownership shares and operating in the real estate, we're not all going to benefit exactly by the same amount. But I look at it as, if the real estate company has to take a hit to benefit the operating company, then I'm willing to do that for my family, and vice versa. The question is our family business 100% family owned, and the answer to the question is yes. So the way we're making it, so I live in Memphis. I meant to put this in the presentation. So steady state, my brother is the operator. He lives in Little Rock, manages the day-to-day stuff. I live in Memphis, and I participate as an owner within the company. And from time to time, what I call help or assist, my brother probably has another word for it, the business from time to time. And that's how it works. Now, is that optimal for everybody? No. But for us, I think it's good, because I'm being outside of the business. I can sometimes give a different perspective than someone who's having to wade through the day-to-day stuff of operating a fast food franchise, which can be pretty difficult. Okay, so I'm going to leave you with 3 main takeaways. the first one is about succession. So if you're going to sell or transfer, take the time to please think through that process, because it's so intentional and it's such a big transaction. It deserves a lot of attention before you get into it, and have a good entrance plan before you go, and leverage folks who are knowledgeable about your brand, especially if you're going to be selling, because they're going into unfamiliar territory. So having some wise counsel there is going to be advised. The second is to have at least a rudimentary continuity plan. Don't try as much as you can not to get caught out. There's already going to be enough confusion and chaos going on when the next thing comes. So as much as you can, have a thought about what you're going to do, so that you don't have to plan when you should be executing. And then lastly, I can't emphasize this enough: be financially resilient. If people are knowledgeable about the Burger King brand, we've had some franchisees had some challenges over the past year. I don't know exactly what happened in all those different cases, but I can tell you that the common thread to all of them probably was that they had too much leverage. So just be careful when you use that, because that can work out well, but it could also be the seeds of some other kind of outcomes that are a little bit untoward. So thank you very much for the time. I really appreciate it.